Hello and welcome to another episode of IDL, the business trailblazer podcast for seasoned innovators, rising disruptors, and inspiring leaders. I'm your host, Chris Britton, and today's bright business mind is Jon Timmis of BTR Future. Jon leads the charge in revolutionizing the financial industry with AI-powered, human-centric solutions designed to reduce losses and enhance decision-making. His forward-thinking, somewhat disruptive approach is paving the way for a smarter, more resilient financial future. So let's kick things off. Welcome to the podcast, Jon.
Thank you. Nice to be here.
So, Jon, I am very, very interested to hear more about your product. I think maybe if you start by an explanation about what it is you do, and more importantly, how have you got into this? So how has it all started for you?
How has it all started? Well, I've been in financial risk now for nearly a quarter of a century, which is quite scary for me, really.
Wow.
So I've worked in some of the kind of the big banks and financial institutions. I've worked with all the kind of credit risk agencies, most of the credit and consumer products really out there for in the finance sector to do reviews and risk ratings. I've also, as part of that and part of that kind of journey, I worked alongside with Credit Kudos in product development, if you know them. So they were an open banking provider that got bought by Apple for £150 million, which is very nice of them. So they bought them, disrupting the market there. I've also did financial education as well. So some of the kind of my insights come from doing financial education, going out to schools and kind of teaching the kind of the best budgeting behaviours and things like that for about 4.5 years through a number of different companies and helping out there as well. So the product, the product is essentially looking to basically try and help those customers, those clients of ours, so bank, financial institutions, etc., who are looking to approve the people that are unserved or underserved in the financial market. What I mean by that is that there's a number of customers who are already getting approvals elsewhere, but they're maybe getting approvals for a higher APR than they should be charging, or a higher cost generally of the finance product they should be receiving, or they're not getting served at all. They're not getting any applications. So applications are being rejected from all those different providers. So our solution is trying to basically find a place for those, and by risk rating them in the right kind of way. What we try to do is a kind of the credit file approach, which was one from the 1990s, effectively. Look to take over from when you'd go to your local branch for your building society or bank. That bank manager would know you, know your background, know your family situation, know how you dealt with your money, how you dealt with your property, where your property was, or what your car was, how that was operating, and that. All the details about you. They'd know you very well, but that was the only place you could go to get finance. Credit files came along. They basically gave access to the understanding of their payment records to everybody, which meant a lot more people got access to finance in a lot easier way than they had before. But it also meant a lot of people missed out, because if you haven't got a wealth of knowledge, a wealth of information on your credit file to basically say that you are really good with credit, or if you've just had some experience that's happened to you in life, you've lost your job, you've lost your partner, or whatever, kind of the bad situations in life that can change, they can have an impact on your credit file that takes a long time to basically look to repair. So credit files were a great thing, but then the people who those kind of things happen to, got limited information there, or they've had a few problems in the past, those kind of people will find it hard to access credit because they just don't know much about the individual. So what we try and do is pull the details we can from open banking information, lots of understanding of their budgeting skills and things like that, whatever, their affordability ranking, and lots of information about their property, how they deal with their cars and things like that, all about their life, and to bring the same kind of way that your bank manager would have traditionally looked at, to give a proper assessment of that individual and what they do and what their risk is going to be. So it makes a big difference in terms of risk rating those individuals to make sure that our clients can look to serve those individuals, and those individuals can make a big change in their life by getting access to finance.
Got you. So if let's say that it came in on the stroke of 1990, so over those last 34 years, there's been significant developments in credit searches as a whole and credit bureaus and how they operate. So initially, I can remember where you couldn't do a search for credit without it impacting your credit file. Now they've got soft searches. There's ways that they can get glimpses into it. So this is another advancement that are you assessing even things like rental payments, because obviously more they don't show on credit files at the moment. What level of detail are you going into to be able to extract that information?
Yeah, we're going to a lot of detail. So this isn't saying that credit files are at all bad. We use credit files as part of the assessment. So it's basically just enhancing those is what we're trying to do. So yeah, there's a lot of information, especially for those people that haven't got much kind of normal kind of credit file information reporting details that we can pull out. We can pull out from their current account information, their payment history on their rent, on their council tax, on their utility bills. And for those people that have childcare, they will know how expensive childcare is, and that doesn't report on there. It's quite often sometimes more expensive than your mortgage. To basically say that you've made those payments, that you're good with those kind of payments, can show a really good history.
Mm-hmm.
So we're taking that kind of information into account. But one of the things I also say is a kind of really big measure is all those budgeting skills that Martin Lewis and lots of people out there are teaching about how to save money, how you can make sure that you're spending money on the right kind of things, that you're making sure your income is maximised and things like that or whatever. None of those things get reported on the credit file. If you reduce your gas bill, it doesn't get reported on the credit file. If you put away money into a savings account, it doesn't show on your credit file. If you have £1 million in your current account, it doesn't show on your credit file. It only shows how much money you've got in your overdraft. So all those kind of things are completely missing there. So we're trying to basically bring all that detail in, understand as well about any assets that they have and the care for the assets that they have. For example, a lot of the companies that we deal with are automotive companies. So we can generally pull out from most people's current account information about not only about the kind of care of the existing vehicle that they've got, but quite often the vehicle they've got as well. Because the actual registration of the vehicle will show if you pay tax through there. So you can pull out the registration of vehicles and we can understand how often you do it for MOT, how much you service it, and things like that to understand the risks of if it's an asset facility as well.
So you're given a more complete picture of an individual, effectively, that you can then pass that as a line of data to a lender, and that lender can then make a more informed decision. Effectively, that's the path you're going down. But ultimately, your goal is not just to make it better for lenders, but also really to give a better experience for end users and consumers who are going to be able to get better rates and things like that.
Absolutely. I mean, the one of the lenders I had a credit risk for, 247 Money. We're part of a company that did car finance brokerage, car finance 247. Our whole MO really as a company, as a lender, was to help those people that wouldn't get served at the moment in time by the other lenders on the panel. So we're always looking at ways to kind of help those people. So there were generally people that had fin files, had limited information on credit file. And the information about the customers, about the kind of behaviour of the customers on the vehicle side really helps in this kind of details as well to make the application reviews. But I've kind of gone beyond that, and we can look to help a number of other people. So you have people that are currently retired. If you're retired, you very generally will get rejected. If you've been in your job for less than a year, you'll generally get rejected for information on there. Same with like self-employed customers. If you're a younger customer, you will generally get rejected. If you've got less than 3 years address history, you will also get rejected. But by having all this really holistic perspective about the real understanding of the customers, then it does make a massive difference to be able to get those people into the right affordable finance for them. If we take the young people, for example, because it's one of the biggest populations out there that currently are underserved or unserved, that you may not take out credit cards nowadays and loans and things like that, whatever. And anyhow, even if you're offered it initially, because they're generally kind of rubbish rates and things like that, whatever. And I'm not going to say the same kind of things when I was young. You haven't got the same kind of offers. But you could be really good at your budgeting skills. You could have a really good job. You put money aside, you put money into savings. Everything you do get, every little bill you've got, and whenever you pay off really brilliantly, you could be paying your rent basically really well and things like that, whatever. So you've gone from a customer who is very new in terms of experience of credit, maybe 24 years old, which doesn't sound that young, but in terms of credit files, it is. That have got no credit facilities apart from a current account, and therefore would be considered very, very high risk and probably rejected everywhere, pretty much. To a customer that you know that they've got a good income, they've been in work for ages, they've got their salaries increased over time, they pay off all their bills on time, they pay their rent, their utility bills, their council tax, or brilliantly never missed a payment. They put money aside, whether they go on holiday once a year, but they budget for it. They put savings in for 6 months beforehand to basically make sure they've got money for the holiday and spending money, and they just really perfect in terms of the way you would want a customer to be, in terms of a responsible customer that you should be giving that facility to. And then you've gone for a customer you don't want to give a loan to potentially one of your best customers out there.
Got you. So on your journey then, understanding all of this, I appreciate that you've come from this background, and you mentioned right back at the very beginning, this is the foundations and the bedrock of your career, and this is where you've generated a load of wealth. But what then has been the biggest challenge, even though you've got that wealth of information, for you to be able to get this product developed and get this out on the market? Because there's a lot of moving parts here and a lot of factors that you're considering when you're developing this product. So what would you say has been one of your biggest obstacles or biggest challenges that you've had to overcome?
The biggest challenge has really been a kind of just combining all the data together, because you've got lots of data coming in from lots of different sources. Quite a lot of it is kind of unstructured or semi-unstructured in terms of the data. And because of what we're looking to trying to achieve, we're often not just doing things off the shelf like other people would do. We're not just taking even if we're getting the data from a particular supplier, we're often doing some of the translation ourselves to make it what we would consider a better and more usable view for the particular end point, the end reason that we're trying to achieve it. So like the transactional data, for example, there's lots of open banking providers out there will give you really good categorization of the data of the transaction in the customer's current account. However, we want it to be viewed as in a risk perspective. So we do a risk categorization on top, which basically gives a whole different perspective in terms of like, well, shopping at grocery shopping, you could just put everything, every supermarket, every corner shop, whatever, into grocery shopping. What does it tell you about risk? Well, it doesn't tell you anything really. But if you're kind of going, okay, well, I'm going to categorize some of those things in terms of low cost, high cost supermarket, something like that, whatever, then you will get an idea of like how the pattern changes over time, whether or not they're making the right kind of budgetary concerns, something like that, whatever. And again, things like savings and whatever, just basically saying it's savings. Well, that's different from savings and investments, something like that. There's lots of different things that carry different amounts of risk in relation to it. So it's understanding all those different elements, whatever, putting it all together, putting our layers on. Effectively, it's been a challenge, but a really interesting one, and made our kind of position unique. It's something that really means it's possible to copy what we do, but it's very difficult to make it as good as we're looking to do. And also, a lot of the companies out there just don't have the good reason to do so, because they want to basically carry on selling what they've got, which is generally, I mean, like they're kind of credit rating agencies. They have good products for the majority of their clients. They're really good. They're really brilliant and do the right kind of thing. But we're looking at their kind of the particular customer base, who those particular products are the weakest at.
Got you. So you're effectively, while you're still augmenting the data and you're effectively orchestrating all these data pipelines that are coming in for each individual. And it's quite interesting because we did a podcast not that long ago with someone who literally is a professional in data orchestration. They're a data manager, and their platform is focused on data augmentation effectively. But you're bringing in these data pipelines, and then off the back of those data pipelines, you're also connecting then with open banking. So let's say you take their credit file, you're taking their open banking, and then you're applying your own blend on top of that, which has then been a challenge to understand what the lenders actually want to see. Or how have you defined what lenders expect to see in order to create that risk profile? Is that purely based on
So
experience?
it's a combination of things. So it's based on experience, but also working with some of the lenders that are already kind of they're working with us right now, to kind of to demonstrate the power of that, and also kind of to refine the kind of process to understand it all together. Now we are currently a consultancy firm anyhow, so we through that consultancy we learn more and more as well in terms of how our product will be used by them. Because I know at the moment in time, it's predominantly how I, as a director of credit risk, would have made those decisions and things like that. And the whole thing came about from the fact of getting frustrated that these kind of products didn't exist out there.
You've
So
stolen my
especially
next question, which is what's your driving force behind this? But we'll get to that in a second.
yeah.
So it's effectively from what you would have liked to have seen when you were making these decisions in the past, and because those are often the best products that exist out there. They're products that are driven by the users and the people that are effectively that are born from frustration. So the
Yeah.
frustrating part is, I wish I could see this about someone, or if I knew this bit of information, I could make a more informed decision about whether they could afford this product or not. And it sounds like that's what's been your driving force behind this.
Yeah, effectively. So that because I know there's a market demand because I was demanding it. I was going to these companies and going, "Well, why can't you produce this for me?" They're like,
Yeah,
and
yeah.
they would, and even when they were telling me that, I got frustrated because people would tell me that it's impossible to do it, and I'm like, "No, look, I've just created a spreadsheet, done that thing for you. I will send it to you, and I'll show you exactly how you do this." And they still didn't make it. So I'm like, well, "Okay, well, I'll just do it then because it's well, I know how to do it."
So they don't have the appetite to create the product, which is probably quite a daunting thing for any entrepreneur going into business, that you've got businesses with millions and millions and millions of pounds at their disposal, and they're going, well, it's not on our roadmap. We're not that interested. And then you're coming along going, I can make this and I can make this work with the funds that you've got available. That's quite a daunting journey to embark upon for anyone from that point of view.
It is, but it's also exciting, and I like having the conversations with the clients that we've got at the moment in time, and the ones that we're currently going through the sales process with, because I understand their challenges. I'm not coming at it from. I'm not generally kind of the no degradation of the salespeople from most of the credit revenue agencies people, but most of the people I spoke to are salespeople. I'm not a salesperson. I'm a person who has done this, been a head of credit risk, been a director, and in a risk director position. I know the challenges that are out there, and I know this product addresses them, and I can speak to them in secular language. So it's kind of interesting for me, daunting but interesting.
Daunting but interesting. Well, that's that's an exciting thought, and I think that's really what ultimately drives any entrepreneur, is the whole is calculated risk. Ironically, considering what you work in,
Yeah.
it is calculated risk, and making sure that obviously the investment ultimately pays off for the direction of travel of where you want to take the business and what you're wanting to achieve. So based on that, then, what do you think, if we're to future gaze here and we're position you as a visionary for this part of the conversation, what do you think it's going to look like in the future, considering how much it's evolved over the last 35 years that we've just mentioned? What could the next 35 years look like, and what do you expect that to look like for many people, even from an educational level as well, and understanding how finance is used?
Well, speaking about my particular product, I expect that kind of my product and products like this will be much more widely used to assess individuals, because it's a better, fairer system of assessment. And I can imagine then developing the same kind of ways like credit files are developed. I mean, credit files started off small. It was Great Universal who started off credit files. There was no such thing as credit files, particularly in the whole of the world, until Great Universal started off. So, and they're a catalogue company that's basically gone by the wayside pretty much now. But they started off the journey, and it was slow at first and kind of exploded up. So I can see that being a kind of bigger thing there. But I can also, in the kind of wider perspective, what I can also see happening is you starting to see a number of companies, including kind of like Lloyd's, ClearScore, banks, building societies, and credit referencing agencies, all giving tips on how you can increase your kind of credit score and how you can manage your money. And he's saying kind of point from the other side, really, in terms of budgeting skills and things like that. Martin Lewis and things like that, and his budgeting skills and process and things like that. In terms of managing your money from a non-credit file perspective, are becoming more and more mainstream, and people are starting to listen, I expect. And I hope that the kind of approach that I'm looking to take can then be given to these the people out there as well, the individuals out there, and that we can at some point, and we're going for an FCA process to do that at some point, can at some point be given back to that customer and basically saying, look, this is what you're doing at the moment in time. This is how we've made the assessment about you. These are the ways we believe it can help you to make more of the right decisions from a financial perspective, to basically looking to help get you to the goals you want to achieve. So hopefully we can look to do that. One of the other things hopefully we can do as well is we can change the way the kind of payment system works, which is one of the things I haven't talked about particularly yet. But at the moment in time, most payment systems, in terms of like when you want your payment to come out, aren't very well aligned generally with when you actually get your main income, and that can cause friction. So a lot of the kind of the collections operations from the finance company side and the collections calls from the consumer side and the kind of the concerns and kind of messing with that, the kind of the issues that causes come from just that disconnect between when your main income comes in and when your direct debit goes out. Because even if you say you get paid on the 25th of the month and the direct debit set up for the 25th of the month, it doesn't always happen that way. In fact, the 25th of the month is the kind of the one where only half of the year generally that will come out on the 25th of the month. Because you'll generally, because of the way kind of bank holidays, weekends, and Christmas work, it kind of moves it. So we will look at and make a proper assessment of when your payment is, when you're getting your income, and kind of link that up better with when your payments come out. And hopefully we can do more of that. Between ourselves and other companies out there, we can do more of that and actually get rid of those issues, because lots of debts are kind of like a snowball effect. Those small little things where you've missed one payment, you then get charges, or you've moved money about when you shouldn't be moving money about, whatever, and it snowballs. So if we can get rid of that snowball effect, we can hopefully get rid of a few problems as well from the back end as well as the front.
Got you. So are you saying then, have I understood the product right? Maybe I haven't here, so apologies if I haven't, but do you make the recommendation to the lender based on when the best day to take the money is, or are you just taking the payment date to then say, okay, you are managing your money really well based on the fact that you get paid on this day, but your DDs don't go out till this day, and this day, for example?
We will generally make the recommendation to the lender to basically say, we believe you should go to the customer and basically check if they were okay with this process. Literally give them a series of dates when the payment should be coming out for the next 4 or 5 years or whatever, however long the agreement's for. We can do that assessment, and therefore we know that there's a better chance of that customer actually making that payment on time every time. And we can suggest as well, if they need to split it, that they split it. So there may be no particular occasion, because people have very complex lives and complex income nowadays. They sometimes get their income from the main salary in a podcast, for example.
Yes.
So those incomes can come at different points of the month. So in which case, it may well be that if you need to take £200 off that customer, there's not actually any point in that month that you can take £200 itself. They can afford £200, but there may not be there may only be a 75% chance that you can take out £200 at any one particular day. There's no perfect day for it. But you might be able to split it and basically say, okay, well, your main income comes in on this particular day. We can take £150 at that point. 95% chance that there'll be £150 in there. And there's a 95% chance that there'll be £50 in somewhere else in the month. So we can split that payment. And again, we can make it better for you. We can make it better for the lender as well. That it's all synced up. You don't need to worry about it. Effectively, you're being helped with the budgeting skills themselves.
Fantastic. So it really is turning the value of what a credit reference agency is doing on its head for lenders, and you're effectively trying to make credit more accessible for those who need it, but for those who do have it or have access to it, have a better experience and a better rate, and make sure it's still something that's truly affordable. Because ultimately, as you mentioned earlier, a lot of the credit reference agencies are pumping a lot of money into helping people improve their scores. But ultimately, that's just a self-fulfilling prophecy for them, because all they're doing is getting people to improve their scores, then attacking them with affiliate links, where they then receive a referral for every successful application. So ultimately, they are doing it because it's generating them a secondary form of income. It's not their primary. I totally understand that, but a secondary form of income is effectively selling credit solutions and options to people. So what you're doing is really turning the whole situation on its head and saying, what can someone truly afford, rather than what does this picture that's been painted of you, or what's this perception that we have of you, effectively say.
Yeah, another way of kind of looking at it is effectively kind of, if you think of the credit referencing agency like a kind of like a CV, right? So if you think about ways to improve your CV, there's lots of different ways to improve your CV, and credit in the credit referencing agency files are a bit like a bit like a reference, a bit like a reference on your CV. So they'll basically show you had a good record, where you've worked, what experience you've had, and things like that, which is brilliant. But then as soon as you leave that job, obviously, if you've got a new job, you've only been there a month, then it doesn't look particularly great, and whatever for that if you're trying to apply elsewhere. So they're trying to do the best way to kind of fill in your credit reference, so your application, as if you would go to a new job. But what we're trying to do is actually make your career generally better. Make sure you're in a better situation, that you are having the right kind of experience you want to do so, having the kind of work-life balance you want to do, and all that kind of thing. We're trying to basically understand that more holistic picture of really how you are achieving your goals, and how ourselves or our clients can kind of help you achieve more generally where you want to be. So it's not that one of them is bad, but it's just both of them should be worked together. However, we think ours is a more holistic approach, works better for those people that haven't got this really in-depth CV that can go elsewhere.
Got you. Okay. So, one question that I've got left is, many people that listen to this podcast are entrepreneurs themselves. And one of the things that I like to ask people who have come from a background of where they've had extensive employment, and then they've gone, right, I'm going to go this alone, and I'm going to go and do my own thing, which is obviously a very exciting thing to do. What bit of advice would you have for anyone who's venturing out there for the first time and doing what you're doing, and effectively going against the status quo and trying to challenge what everyone is quite comfortable with, and change people's perceptions? So what advice would you have for those kind of people?
I would always say to have accommodations, as many as you can do so, with people who are potentially going to be your clients or have experience of basically getting hold of the right kind of clients in the right kind of way, to understand really what that people are looking for. And that it's market research and things like that, or whatever, to understand, because you can have a great idea, but you have to know kind of like how to get that into reality, and then get that marketed to the right kind of people. So making those kind of connections to who can help you on that journey, and who can fill in the blanks as well, in terms of like, what are your weaknesses, what are your strengths, and whatever, and who can you have helping you along this way. I haven't done this on my own. I've had help from the people that I've known over the years, and one of my directors was my old boss. I think it's really done a great deal to help me and kind of fill in blanks for me in terms of what is where I lack or not quite as good. Those kind of skill sets to fill those in.
Brilliant. Well, thank you very much. That's sound advice from you there, Jon. And I really want to thank you also for taking the time out to join the podcast today. Sadly, that our time is up and over, as always. I love
Sorry.
going into these in-depth conversations, so I do apologize, but thank you very much for joining us. And for anyone who does want to connect with Jon, wants to find out any more information about what Jon's doing at the moment, or maybe this product is of interest to you, please do reach out to Jon directly via LinkedIn. All his details can be found on the IDL podcast website, which is idlpodcast.com, and his LinkedIn details are at the bottom of this episode. So thank you very much once again, Jon, for joining us, and we look forward to welcoming you all to the next episode.